since we're talking about why multi-asset trend and multi-asset macro trading are useful and empirically more useful than just commodity trend and commodity macro trading. And it's because sometimes the best place to bet on inflation is by shorting bonds. Sometimes the best way to bet on a negative growth shock is to short equities. And so, just the commodity trend idea is, it seems intuitive, like you kind of want to get long commodities and you like the trend overlay, but you're missing the opportunity from shorting some of the markets that are functionally designed to not do well in inflationary shocks, like bonds, for example. And that's why the multi-asset trend that includes allocations to trend equities and trend FX and trend rates does substantially better than just the trend commodities in virtually every period.
And there's a reason why you get to kill two birds with one stone, as Rodrigo says, is that, well, what causes major prolonged bear markets? Well, a lot of the time it's substantial and persistent inflation shocks. So
which the central banks need to step in and raise rates to the point to slow demand in order to contain inflation. Exactly. Yeah.
Yeah. And so there's a structural reason why you have this opportunity to hedge a portfolio against these two very critical risk factors with this approach. Yeah. Because that's driven by these inflation and its volatility and those shocks that come with it. So you've got some offset, and that helps attenuate those large drawn out bear markets.
And Adam, just to put some numbers to the comment that you made about why not just trend commodities versus trend all assets. In the Man paper, you can see here that trend all assets during an inflationary regime.
You're not sharing your screen, Ron. If you're,
I'm not going to share. I'm just going to talk. Oh,
I'm sorry. Yeah. Okay.
Yeah. So trend all assets. Let's talk about trend commodities. Annualized at 20% during the 19% of the time that was inflation. So 20% during inflationary periods, and 8% other. Right. Positive return. So positive carry and other. 20% in inflation. The all asset did 25% annualized, and 15% in other. Right. So, this is an interesting thing. Again, the intuition is that you want to do commodities, and the intuition, well, why don't we do commodity trends? And then you come to the conclusion that it's not just about inflation. It's about all of the dynamics, the knock-on effects around inflation volatility.
So let's sorry, like you finished up.
Just last point. We hear this over and over again as we're interacting with allocators, investors, advisors, this whole idea, well, I'll just buy some energy stocks, or I'll do this little thing, or I'll allocate here and there. And it's kind of a step in an okay direction, but if you can broaden your mind a little bit and open your mind and do the work in order to get comfortable with the strategies and understand how the allocation methodologies work, I think you can get comfort and actually be excited about the opportunity to differentiate, given the potential for a slightly different regime or a significantly different regime.